Good morning everyone and welcome to the Moneycontrol live stream. You're watching markets with Santo and CJ. Well, a lot on our plate today, but in the spotlight, of course, there can only be one sector, and that is the metal space. The government over the weekend has finally withdrawn the export duty that was imposed on steel sector as well as iron ore exports as well. Now, when the government had imposed this duty back in May 22, at that point of time the argument was that steel prices, iron prices had jumped quite rapidly over the past 12 months, especially in the wake of the Russia-Ukraine war back in March 2020. Because of that, global commodity prices were rallying, domestic steel prices were rallying, and a lot of industries which were consumers were not happy about it. So the government imposed duty on steel that helped bring down domestic steel prices by as much as 25% lower from the eve of the imposition of the export duty. Now, going ahead, of course, Santo, sentimentally, this is going to be a major booster because the sector had been asking for it for quite a long time. I think especially from mid-August to late September is when the demand for scrapping the export duty started cranking up, largely because domestic steel prices had fallen about 25 to 30% in some cases from their May levels. That said, going ahead, of course, Santo, while this is going to provide a sentimental relief, the major question mark would be about demand. Now, as we know, globally demand has come off quite rapidly for the steel sector because of impending fears of a recession in the US as well as Europe. The US property market also not doing that well in the past 8-9 months. The Chinese property market not doing that well as well. But hope remains that if China does see a reopening probably from the first quarter of next year, and there is a revival in the property sector there in the Chinese economy, that could help drive global commodity prices, including steel.
Well, as you said, one of the lines that you mentioned, hope is that these things will happen. I think hope is eternal, but if you look at the ground reality, it is something else, I would say, CJ. So for one, I think steel stocks would have already to some extent discounted that a cut in export duty was coming. Okay. It's been spoken about by many analysts, and to a large extent I think the prices already reflect that. Secondly, if you see, CJ, if you look at the export market for steel at this point in time, given the weakness that you yourself mentioned in major economies, US, UK and China right now, demand is quite down. So it doesn't really help at this point in time, even if they were allowed to export more. And as brokerage house CLSA has pointed out, already domestic prices are at a premium to both import and export parity. And other brokerages too, in fact, almost all the brokerages which have come out with their reports today on the move have pointed out the same thing, that near-term boost to earnings looks very unlikely. So probably the rally the recent rally may have captured most of the upsides, and once again the focus will likely now shift to domestic demand, which at present is just about steady. Realizations are also just about steady, and this is a fact which has been highlighted by the steel makers as well. So further upsides from these levels, CJ, looks very difficult, although I would say yes, the move is a positive, but don't expect a runaway gains in steel stocks at this
Santo, your argument is as slick as your haircut. But that said, I think
thank you for that.
I think companies had indicated that there will be an improvement in realization, and the fact that domestic prices are now currently at a premium to what import realizations are at this point of time indicates that probably the domestic market was also anticipating that the government will remove the export duty. I think that also should start reflecting in the third quarter as well as the fourth quarter. There should be improvement, in sequential improvement at least, as far as realization is concerned for steel sector. And let's not forget that maybe a lot of the brokerages have indicated that near-term earnings implication are not that great. But the likes of JSW Steel, for example, or NMDC, which is expected to be the biggest beneficiary of this move, are likely to see some amount of upgrades to their FY24 EPS. Nomura indicated about 5% upgrade could be expected for JSW Steel in FY24. So I would not say that it's not beneficial or there is limited benefit for most of the companies. Of course, as I mentioned, NMDC would be the stock to watch out for in today's trade, because clearly that is the one company which had seen price cuts after price cuts month on month. But now hopefully with realizations improving, you could also start seeing some bit of price hikes coming in from the company, as well as probably improvement in export volumes going ahead. Yes,
Yes,
sorry,
please go on.
No, just moving on to the trade setup for today, and of course, it's looking like a muted start for Indian markets. If you look at the FTSE Nifty futures, they're indicating almost a 80-point cut on our benchmark index, and that is largely down to what is happening with the Chinese economy at this point of time. The Hong Kong tech index down about 2.5%. The Hang Seng is down about 2%, and that is after fears of renewed COVID cases in some of the major cities. That has led to fears that probably China will again start imposing lockdowns at major cities. Hong Kong's, one of the leaders of Hong Kong's actually, who had recently attended Asia Pacific Summit, he has ended up coming back with a COVID positive test, and at this point of time, with the zero COVID policy of China, I think that is going to be a sentiment dampener as far as the global markets are concerned. Apart from that, the handover from Wall Street on Friday was largely positive. They ended up marginally higher on Friday, but the only positive, the other positive for us would be the crude oil prices. Crude oil prices now firmly below the $90 per barrel mark at this point of time, clearly over concerns whether Chinese demand will come back in 2023, Santo.
Well, CJ, I would still go by liquidity at this point in time, which appears to be fairly strong, and so I would bet in favor of the market making a all-time high in the near future, CJ. That said, probably mid caps and small caps could struggle for some more time. That's where interest is not really coming in. The earnings from most of these companies have been just about in line with expectations. Majority of them have actually seen a reduction in their EPS estimates. The rally, if at all, will continue to be led by frontline shares. And that said, quick look at the FNOQs now. Short positions in Tata Motors stock in NSE's SLBM segment, that's seen a sharp reduction. It's come down to around about 2 million odd shares. Remember, this was as high as almost 7 million shares just last month. Now, you mentioned NMDC, CJ. Already we saw a fair bit of short covering on Friday, and probably that trend is likely to continue today as well. The other futures where there has been short covering of positions include Birla Software and Cholamandalam Investment, and long build-up is being seen in I beg your pardon, short build-up is being seen in shares in futures of ONGC, PVR and Polycab.
Well, thank you, Santo, for the FNOQs. Moving on to the newsmakers of the day, and the first stock on my radar today would be Zomato. News came out over the weekend that the company's co-founder Mohit Gupta has decided to move on from the company. So that is clearly a major setback. It's the third high-profile exit from Zomato in recent times. So clearly there are concerns over some bit of uncertainty at the top management of the company. That said, there is an indication, that probably the current co-founder, one of the, the biggest leader in the company, the CEO of the company, will take over the food business. So clearly there is some clarity coming in there. But that said, overall, Zomato has also indicated that they are planning to trim their workforce by about 4% from FY22 end levels, clearly indicating that they at this point of time are chasing profitability. According to some brokerages, channel checks with restaurants are indicating that demand is now tapering off. Clearly that post-COVID high that we had seen, that pent-up demand that we have seen, is now tapering off and is normalizing, and it's clearly a move towards balancing growth with margins as far as Zomato is concerned.
Well, the tapering of demand, CJ, I think also has to do with the fact that food prices have also increased considerably. So people are in fact thinking twice about ordering.
Yeah, but the RBI thinks that inflation is coming down, Santo. So I don't know whether the RBI is wrong or our wallets are wrong.
Definitely. Well, IEX is my newsmaker for the day. Now, the company's board will be meeting on November 25th to consider a buyback. The stock has been struggling for some time now. IEX is a energy marketplace, and the stock is down about 46% year to date. Second quarter numbers have also not been very impressive. Sequentially, revenue has grown by just about 0.3%. It's been flattish more or less, and net profit has risen by about 3%. So at this point in time, sentiment for the stock is quite weak.
Well, Santo, talking about sentiment, which is your top hot brokerage bet of the day?
Well, Escorts by JP Morgan. JP Morgan has an underweight rating on the stock with a target price of 15.25. Now, JP Morgan has flagged some of the positives about the company. Latest quarterly numbers were quite decent. Besides that, the company is aiming to grow its revenues by 2.5 times over the next 3 years. Besides that, JP Morgan feels that margins will definitely improve in the coming quarters, and for FY23 the operating margin should be somewhere in the mid-teens compared to less than 11% last year. But at the same time, JP Morgan has also cautioned that much of these positives are already reflecting in the stock price at current levels, which means that probably the stock price has moved ahead of fundamentals, and so it could perhaps consolidate for some time.
Well, my top brokerage bet of the day would be JK Lakshmi Cement. A report coming out from the house of Geojit by BNP Paribas. They have downgraded the stock to hold rating with a price target of 703. Now, the reason for their downgrade from buy to hold is largely based on valuation and the fact that the stock has run up quite sharply in the past 6 months. So clearly it's largely has nothing to do with the fundamentals of the company. There is no deterioration there, but it's because of the valuations running up quite ahead of fundamentals according to Geojit. Also, they have raised, that said, they have raised their price target for the stock by about 27% to 703 rupees, as I said earlier, largely on the back of very strong second quarter earnings within the cement pack. While we saw quite mixed sort of earnings from the entire sector, JK Lakshmi Cement clearly was an outperformer, and that is due to the fact that they are seeing a continuation of strong realizations in terms of price realization for the product, as well as volume growth in the second quarter. So there is expectation that will continue, and therefore we have seen the stock being in so much demand. But clearly Geojit by BNP Paribas at this point of time feels that the valuations are just too pricey.
Well, and with that we move on to the stocks on our watch list this morning, beginning with IRCTC. CJ, just a year back the stock was the toast of the market, favored by fund managers, traders, everyone alike. But what a difference 1 year makes. Now the stock has been range bound for a while, and while the second quarter numbers were pretty decent, again there seems to be indications that most analysts are now turning cautious on the stock. At least they feel that the big upsides from these levels could now be could kind of be capped. Moneycontrol Pro 2 is among those who feel that maybe one needs to be cautious at these levels and probably wait for a better entry level. Now the big one of the factors which has led to a slight deceleration of earnings to some extent, well, we'll get to that in a while. Let's have a quick take on the market this morning. Bearish start there as expected. The Nifty is down by about 57 points in early trade. Market breadth is good though. 1000 stocks up and about 800 stocks down. Nifty mid cap down marginally. Nifty bank is down 0.25%. Sensex is down by about 0.4% or roughly 260 points.
I think, Santo, the reason why the market breadth is doing so well is the fact that the Nifty small cap index is actually still in the green. So that is probably what is pulling the market breadth in the favor of advances, even though that index is, it soon seems like it's off its highs and is inching towards the red territory. But sectorially speaking, banks, automobile stocks, IT stocks among the top losers at this point of time, clearly indicating some bit of pressure there. But the metal space is doing quite well. The Nifty metal index higher by about 0.9%, clearly an outperformer within the space. And within Nifty metal, actually we are seeing Vedanta, Jindal Steel, Ratnamani Steel and JSW Steel actually holding the fort for that sector. The Nifty metal is now off its highs, almost giving up 50% of its gains and now trading higher by about 0.5%.
Well, yes, coming back to IRCTC. Now CJ, during the pandemic, the IRCTC had started a separate segment that even for the unreserved compartments, actually they had converted into a segment called the 2S, and you could book for that, and those earnings from that segment were also considerable. But now that's coming off quite sharply. Now during this year, during the quarter just gone by, the internet ticketing growth was decent, and also expansion of its catering and near that's the packaged water segment also showed decent growth. But on the whole, analysts now feel that the best in terms of sharp earnings growth may be behind for a while now. What you could see is about steady growth from here on, and the stock is quoting at roughly about 55 times 1 year forward earnings, which, given that the growth levers are now missing, the stock is now beginning to look a little expensive, CJ.
I think, Santo, I take your point that clearly the stock has not performed that well in the past 1 year. If you look at from its record highs, down about 40 to 50%, if not more. But clearly, if you look at the earnings performance of the company, that is not reflecting the pain that the stock price is reflecting. Earnings sequentially, year on year basis, they have improved both in the June quarter as well as the September quarter, and therefore I feel that the strong earnings fundamentals or the earnings foundation will continue to provide support to the stock. Whether they will result in upside, I think that is a point that is up for debate. For me, generally, IRCTC was being treated as an internet platform stock back in 2021. That is what led to the rapid expansion in its valuation when global interest rates were quite low, liquidity was quite high, and these sort of stocks were much in demand. That said, now going ahead, any sort of re-rating on the valuation will depend or will hinge on global interest rates coming lower, because that is how a lot of these internet platform companies are being looked at. So if we do see some bit of softening on the interest rate trajectory from central bankers globally, not only at home, I think 2023 could be a year where we could see some bit of revival in interest as far as internet platform stocks like IRCTC is concerned. And moving on, the stock on my radar today will be HDFC, the old school blue chip, of course, the blue chip of blue chip stocks.
That's on your
yes, Santo, but it's a momentum trade. The reason being that on Friday evening, NSE came out with certain changes to its index inclusion methodology, clearly with reference to how to treat mergers and acquisitions of stocks that are part of its index. Now, we both know that HDFC and HDFC Bank are set to merge their operations. Both are also part of the Nifty 50 index, and at this point of time, the new rule suggests that they will treat or they will take action on an index stock or index stocks which are getting merged together only after the X date of that merger takes place. So only after that X date is happened, when that's one stock which will probably get merged or acquired by the another will be excluded, and the merged entity will only remain in the index. Now, how does this rule affect HDFC in the near term? Now, back about 1 month ago to 1.5 months ago, a lot of analysts had come out and said that because of this M&A taking place, and because Nifty semi-annual quarterly review coming up, it was a very good chance that by December, that is next month, or by January, HDFC could have been kicked out of the Nifty 50 index, and that would have led to sharp outflows from the stock, given the fact that the stock holds a major weightage in the Nifty index, and also therefore a lot of passive funds who mirror the Nifty 50 index would have been forced to sell their positions in HDFC, and that could have led to more than $1 billion of outflow according to some calculations. But now, because this merger is because this rule is no longer applicable and this new rule has come in, that exclusion from the index has now been delayed to probably the first quarter of FY24, when a lot of analysts are expecting now that HDFC Bank and HDFC merger will be completed. So in the near term, any sort of short build-up that we have seen in HDFC is likely to reverse. You could see that already probably happen in the recent rally in the stock. But going ahead, I don't think you could see any sort of pain point in HDFC, and it will probably move in conjunction with HDFC Bank.
Well, if you look at the latest development which you mentioned about NSE changing its methodology, that I think has already been factored in, just going purely by the price reaction today. Because when you had a couple of weeks back Morgan Stanley doing that, changing the methodology index to include, to compensate for the M&A factor, I think that is when you saw a big jump in the stock.
True.
And this is something I've been maintaining always. At this point, when a merger is imminent, right, you would like to play on the stock which is going to be in existence after the merger process is through, and that is clearly HDFC Bank. So HDFC to some extent could see some interest from traders in the short term, where they try to make use of the momentum, but other than that, it doesn't make sense to really go on it from a slightly longer term perspective, CJ.
Santo, next stock on your radar?
City Union Bank. Now, this is I'm a little conflicted here, CJ, because if you look at purely at the fundamentals, the stock appears to be in a very good shape. The latest quarterly numbers were quite strong, consistent improvement in asset quality, and that has led analysts to say that most likely there could be a further re-rating, and the stock, which is just about less than 2 times adjusted book value, or about 1.5 times, they should see a further increase in the multiple that market gives. But if you look at the short term prospects of the stock at this point in time, there seems to be some kind of pressure building up both in the F&O market as well as in the ALBM segment. Now, in the ALBM segment, the short position in City Union Bank has been steadily rising and it is now close to about 1.6 million shares. Besides that, on Friday, a lot of call options were written in City Union Bank at 190 rupees. Now, typically when a lot of calls are written, now one way to argue is that a lot of people are buying calls because they are confident that the stock price will move up, but at the same time, considering that usually the option writers is what the where the smart money is, that does make one a little cautious about the stock in the short term.
Well, Santo, short term movements aside, if you look at the fundamentals of the company, they are clearly on an uptrend. Earnings wise, we have seen an improvement in the lender's earning. Also, the lender during his conference call after the second quarter had indicated they are now looking at accelerating their credit growth in FY23. In this exit rate for second quarter was about 12% on a year-on-year basis. They are now looking to ramp it up to 15 to 18% in FY23 alone and probably continue that in FY24. So clearly they are seeing strong demand as far as loan is concerned. Also, the bank indicated that their recoveries also are improving, especially in the restructured book, which had of course inflated during the COVID times. Clearly the recoveries are improving, and at the same time slippages are going down, which is usually positive given the fact that the lender will be able to reverse a lot of the provisions that it would have taken on its NPA asset, and that should in general boost EPS going ahead. So yes, maybe in the short term, probably some investors out there thinking that maybe the stock has run up too much and therefore there is an argument for a little bit of consolidation, but fundamentals clearly at this point of time are not indicating anything. And even on the medium term chart, Santo, if you go through some of the the technical analysis that MC Pro puts out on the stock pages, you can clearly see that in the medium term and the long term, the technical charts are really indicating a very, very bullish uptrend at this point of time. So from me, I don't see any sort of issue as far as City Union Bank is concerned.
Well,
yeah, Santo, of course, we should take up some of the questions coming out from our viewers, and I think, Santo, we probably ought to address dollar industries. This is one stock that has really fallen quite off the cliff in recent months, and I think the major reason behind that is the fact that, of course, the pent-up demand has gone away. I mean, back in March quarter and probably in the June quarter as well, you had a lot of people returning to offices, therefore buying, a lot of innerwear clothes, which probably they had not refurbished their wardrobes for the past 2 years because of the lockdown. But clearly that pent-up demand has now fizzled out. And now when that, demand has fizzled out, the focus again has come back to what is happening in the major area, which is the mass market area for dollar industries. And clearly, if you go by the commentary from FMCG players at this point of time, clearly inflation is taking a toll in the mass market segment, and that is one of the major reasons why you have also seen a lot of shoe companies see a major correction. You look at Relaxo Footwear, you look at Campus Activewear, all of these stocks have fallen off the cliff largely because their exposure to the mass market segment or the low end consumer segment, where the pain from the pandemic, clearly, Santo, has just been exponentially increased by higher prices and high inflation.
Well, if you look at the top line, that's been pretty much steady over the last 4 quarters, and but the major problem has been the rising raw material costs, and that has really shrunk the margins, almost halved it, and which is probably why you're seeing the stock coming off very sharply. It's now off about 30% from its February highs. It's quite a steep decline there. So
yeah, I think we are seeing that across. I mean, you talk about dollar, you talk about Page Industries also to a certain extent. You talk about footwear stocks and Relaxo Footwear, Campus Activewear. These were stocks which are bang on demand in the first half of 2022. But clearly, as I was saying at that point of time also, Santo, pent-up demand is pent-up demand ultimately. That is the reason why it's known as pent-up demand. It does not last forever. It only lasts for a particular period of time, and then you see normalization. And probably the correction that we are seeing in a lot of these stocks, Adi is clearly an indication that demand is normalizing, and therefore the market is also normalizing its expectations of future earnings.
Well, very interesting chart there. There was a dramatic re-rating of the stock between Jan and Feb.
Yep.
It rose by more than 50-60%, and from then it's been steadily coming down. Volumes have also, I think, not crossed the levels we had seen in February.
Well, Santo, another question coming in, and I think this is one stock that you have also had a sort of a negative outlook in the past, and this is Gangadharan Ramesh talking about SBI Credit. Now he says that the stock has not been recovering, and at this point of time, what could be the outlook as we approach the November expiry later?
This is SBI Cards, is it?
SBI Cards, yeah.
Well, again, it's been the same case as I've been and CJ have been regularly discussing it. The outlook for credit card companies at this point in time is not very rosy. Definitely, SBI Card is one of the dominant player there. It has managed to retain its market share. Second quarter numbers have also been good, but where I think smart money is not willing to bet on SBI unless they get a favorable entry point. A couple of factors here. One is probably the merchant discount rate. That is one of the concerns, whether RBI will cut it sharply. That's a major source of earning for a monoline business like SBI Card. So there are concerns there. Besides, you also have the buy now pay later product becoming more and more popular, especially with the youngsters. So in all fairness, SBI Card has put up a good performance, except that in a rising interest rate scenario, typically that does not work very well for credit card companies, because they benefit immensely from what is known as revolver credit, that is their users paying the minimum amount and then carrying it forward. But when interest rates are high, typically they don't tend to do that, because of which the earnings get crunched to some extent. Well run company, but at this point in time, I think the market is a little apprehensive of giving a higher multiple to SBI Cards.
Well, Santo, on that note, we shall wrap up the show.
Yes, and it's wrap, and thank you for watching and also writing into us. Continue to do that, and we'll continue to respond to as many queries as we can.
And guys, as usual, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great trading day.